ब्लर कर
तो hope we are live.
Yes, sir.
Good evening, everyone. Myself, CS Legend, moderator for this session. So today's session is on the topic relevant amendments and practical issues in filing of ITR for non-corporates for assessment year 24-25. So we have with us the chairman of Direct Tax Committee and the vice chair of Direct Tax Committee, Chairman Piyush Chajer sir, and Vice Chairman CA Kota S. Srinivasan sir. So the vice chairman of this committee, Kota S. Srinivasan sir, is a become graduate from Bangalore University and a fellow member of the Institute of Chartered Accountants of India. He is serving the profession from so long, and he comes from SIRC region. He prepared the concept paper on coaching classes as chairman of Academic Advisory Group. He was instrumental also in developing digital project for SIRC. So with this, I like to invite our vice chairman Kota Srinivasan sir to please give welcome address to all our audience and participants. Over to you, sir.
Thank you, Sahil Lalit Jain, the moderator of the session for today. Welcome to you, and let me also take this privilege to welcome the speaker of the. Welcome to you, sir.
Sir.
I have with me the chairman of DTC, CA Piyush Chajer, and we have the secretary and other staff members of DTC, and all the members who have registered for this particular webinar. I welcome each and every one of you. Today's topic is relevant amendments and practical issues in filing of ITR for non-corporates for assessment year 24-25. Of course, this is a very relevant topic with amendments. Gautam sir is going to take you through this. But let me tell you one thing. Recently, maybe some 3-4 months back, we had a discussion with CPC officials in Bangalore. I attended that. There, we got the statistics that whatever the returns that has been filed, almost 99.74%, or it may be the percentage may be wrong, but it is more than 99%. There is no mistake in the returns what we file, the chartered accounts that we file. So this has been done from several years. Of course, so they were very happy, and the CPC people in Bangalore, they said they really thank the professionals as such. So this work we have been doing. So most of it were correct. So there was very little percentage where it required certain modifications or corrections as such. So most of the returns what we file as a chartered accountants, it was accepted without any flaws as such. But of course, as you know, there is changes in the law and there will be changes in the forms for to see that to sync with the changed law. So that we need to know all those things, and especially today we have Gautam will be telling about the amendments that has taken place in various ITRs for non-corporates. And of course, there are certain ITRs which is used for even the charitable trust and all, ITR 7. I hope he will cover some of the aspects of that, because there are so many amendments that happens with these charitable institutions. In fact, yesterday we had a council meeting from DTC. We have released 2 publications approved from the council. One is a technical guide on guidance note on audit of charitable trust under section 12AB or 1023C, and also one more addendum for changes that has happened in 3CA, 3CD. I hope all the members will make use of this, and we have also given our pre-budget memorandum. The budget is coming in this month. More about the DTC activities, I have the chairman who will take you through all those things. I only wish you that there will be a enlightening session for the next 2 hours. Gautam sir will take you through all those aspects, and let us continue this this thing. What is that? More than 99% the returns what have been filed has been done properly. So that let us consistently, we will continue to do that. So whatever changes is there, please get to know from the speaker. Thank you once again. I welcome each and every one of you for this particular webinar. Thank you.
Thank you very much, Srinivasan sir. It's a pleasure to hear you. Now I would like to request our chairman Piyush Chajer sir, chairman of Direct Tax Committee, to provide the opening remark to the today's participants and audience. Over to you, sir.
Thank you very much, Sahil. Very good afternoon to all the participants over here. I welcome you once again on this Thursday seminars which has been attended widely from the participants, chartered accountant members across India. I welcome our speaker for the day, CA Gautam Mutta, who is an expert in taxation. We have been hearing him since long. He is quite a great faculty, and he generally speaks on Chamber of Tax Consultants also, which is known for the technical expertise also. Sahil, I also welcome you and thank you for accepting our invitation to be moderating the sessions. Secretary of our DTC team of DTC, Rudrakshi, I can see online, and all the participants. Once again, very good afternoon to you. As just to take it forward from where my vice chairman left, CA Kota Srinivasji, rightly he said, and I had also updated you last week also, the guidance note on audit of Form 10B and 10BB has been approved by the council. And yesterday, day before yesterday, because the council meeting was on 2nd and 3rd, it was approved on 2nd. And the soft copy would be uploaded in a day's time, which will be available to all the members. If you want to have a hard copy, you can make a request on our CDS website of ICI. A hard copy would be available. It is very important at the cost of repetition also. It's a very important when you actually discharge your assurance function and you are doing a sign off of 10B or 10BB. My request to all the members would be, please look into the guidance note on this 10B and 10BB. This guidance note is actually to ring fence the members. If you are put to a question tomorrow that whether you have performed the audit procedures properly, whether you were negligent or not, you can always fall upon and say that what is procedure has been given in the guidance note has been followed. If there's some regulatory body or maybe tax body, you are put to a question regarding your assurance functions, this guidance note actually ring fence you. This guidance note, though we always call, because there is an authority attached to each and every document which is issued or each and every publication which is issued by ICI. Guidance note is at higher pedestal when compared to a technical guide which was issued on the same subject in the last year. Now, guidance note is as good as mandatory in the nature because the auditor who would be auditing is required to follow the guidance note. And if is not following the guidance note, it is expected from the regulators that you have performed the alternate audit procedures and documented thereof. And therefore, it makes it very important that you follow guidance. Apart from that, again, the implementation guide on the revision in Form 3CD was also approved yesterday by the council. That has been already released. A soft copy is already uploaded on the website of ICI. You may look into it. The most important, of course, there is no major revision, but the most important being revision in Form as far as 43B subclause H is concerned, wherein the auditor is now expected to report disallowances, which is going to happen in respect of delayed payments to MSME. So please do look into it. It will serve a guidance to it. I always urge the members that in case you feel that what is given in technical guide or guidance note is not in accordance with your understanding, you may feel that my views are different. But I always say whether you may have a different view. The guidance note or the technical guide may be right or wrong. It's not important. But as far as accounting and auditing is concerned, if it is issued by ICI, it has been accepted widely by various judicial bodies. And therefore, I always request that please do follow that. Irrespective, it is like if Supreme Court gives a judgment, you may agree or may not agree. You may say it's a right or wrong, but ultimately, whether it's right or wrong doesn't matter. It is a final. Similar is the status at which the documents or the publication issued by the ICI are placed. I will just give you an example of turnover, which is given, the working of turnover for F&O transaction, which is given in the guidance note. It is upheld by Delhi High Court also, stating that if turnover is not defined in the Income Tax Act, if it has been given in the guidance note, which is made by the body of experts in accountancy, the assessing officer should follow that, and there should be no adjustment to it. So that's the level of which is attached to it. Apart from that, as rightly mentioned, we have already given a pre-budget memorandum of 99-point suggestion was made on 24th of April initially, wherein individually by Institute of Chartered Accountants of India, DTC committee, which was, I was there and my past chairman, Sanjay Agarwalji also was there. We gave 99-point suggestion and gave a 90 minutes presentation covering important 30 to 40 suggestions. Thereafter, they requested us to, on certain areas where they were quite inclined to accept that, they wanted further justification for accepting that. So we gave a supplementary pre-budget. Thereafter, on 27th of this June, again, when they had meetings with various associations, including Chamber of Tax Consultants, which Gautam is also a member, the chairman tax CTC was also present, and we also again gave our representation, adding another, I would say, supplementary pre-budget memorandum was given to them. So this is what I believe. A lot of suggestions were discussed very nicely, and justification was given. They heard us very well, and if it is accepted, it would come in the budget. As far as budget is concerned, obviously we will have a flagship program as Direct Tax Committee we generally have in Delhi, but it would be live telecasted across India. We are trying to have such program on the next day of the budget itself. So generally, if the budget, we are not fixed whether there are 2 dates coming, one is 22nd July or maybe 24th of July. We were expecting when yesterday Lok Sabha session ended, there would be some announcement, but there's no official announcement which has come. So because the next session, the budget session is scheduled for 22nd to 24th. So we do not know when it will come. But these members, I know during the budget sessions, you would be busy with tax filing. And therefore, you have been attending this because you know there would be a lot of issues. It's a very busy season for this July month. You have a lot of questions, a lot of issues. I'm sure you would be raising those issues. And Gautamji, who is an expert in this, he will try to answer those. Obviously, being a Direct Tax Committee chairman, it's my duty. Whatever views would be presented over here, those are speaker views. They necessarily do not represent ICI views. Because ICI being a regulatory body, we do not give our personal ICI views on such webinars. It's a speaker's views, but obviously that will guide you that what action you need to take, what suggestive measures you need to take, and therefore please do raise queries on this. Last, before I end my session, we are working upon ease of doing business also. Ministry of Finance had formed a committee. And the most important area for ease of doing business, you know that India in this government is quite very much concerned about the ease of doing business ranking. It has come down from 120 to 63 and they want to come further down. And whenever this ranking happens by an international body, the most important area is taxation. So we have framed 6 to 7 questions which will be circulated amongst the members. Most importantly, what is the time which has been taken by an individual or a corporate entity to file a tax rate? That has the biggest weightage. What is an average tax rate? Whether there is a digitization. I know you need not answer on digitization because India is far better when it comes to digitization of tax areas, whether you treat it VAT or corporate income tax. But at least if you are able to answer that, it will help us. It will not only help in giving a good rating, giving a good report to a Ministry of Finance, who in turn will go to international body. But if there are certain, supposing you are not happy, so let's take an example for tax filing return, average time should be, for an example, 5 hours. And the response is coming as 8 hours, then obviously it also gives a message to the regulators, that is CBDT or the Ministry of Finance, that you need to improve it. Maybe whether it's required so much large ITR forms to continue when my ease of doing business is getting affected. I'm sure when Gautamji will go through an ITRs and you will realize, if personally I've been told in last 5 years, the disclosure norms have gone up. So you may have in systems, you may have an auto uploaded fields, but still I believe time is taken because the disclosure norms have gone up. So if you are responding to this and if we are able to give this report, obviously they will be also aware. The regulators would be aware that whether they should actually do away with certain disclosure norms, because of which my ease of doing business has been affected. And ultimately, ease of doing business ranking also affects investment which are coming in India. So we have the next meeting, which is scheduled with the Ministry of Finance on 11th of this month. So if you can respond to that, there's Google form is also available on the website of DTC ICI. I would be obliged for that. And please note, whatever matters you are sending to me at dtc@ici.in, each and individual mails have been looked into it. They are compiled into it. They have been discussed with the experts. I'll just give you an example. Yesterday, I received 2 or 3 messages that there is a lot of issues this time as far as 26 AS system is not working properly. We have already made representations based on those messages which have come through social media. Representation is ready. We have put forward before the experts of our committee, because obviously we cannot just take it what is coming from social media. They will verify themselves. And if that is true, tomorrow morning itself, the representation will go. I can assure you to that extent. Obviously, we'll follow up for that also. So that's the way we are trying to work upon it without taking much of your time. Thank you very much once again for joining. Please keep on tracking every Thursday's sessions. I know a lot of people are very much interested in the sessions, which this July month will try to cover more up on the individual taxation, because this is the flavor of the month. So thank you very much once again to all the participants for being this afternoon. Thank you very much, Gautam and Sahil. Over to you, Sahil.
Thank you very much, sir, for your kind words, and thank you for providing this opportunity to me. So now I would briefly introduce our today's speaker, Rajesh Mutta sir. So he is a qualified he is a chartered accountant, LLB and registered valuer for securities and financial assets. He has earlier worked with PwC in the area of corporate taxation. He is also secretary of CVO, Chartered and Cost Accountants Association. He has been nominated as a member of Valuation Committee of WIRC of ICAI for the year 24-25. He is a co-opted member as a member of Women and Young Member Excellence Committee of ICAI for the year 2024. So he has contributed to the institute in many aspects, and I'm sure today's speaker is a learned speaker, and he will give his best, and all the audience will be satisfied. Over to you, sir. All yours, sir.
Yeah, thanks. Thank you, Sahil. At the outset, let me thank the chairman of the committee, CA Piyush Chajitji, and the vice chairman, CA Srinivas sir, for giving me this opportunity to present my thoughts on this subject. Without wasting much of the time, let me share my screen and we would be starting with the topic. Sahil, if you can just confirm if the screen is visible.
Yeah. Yes, sir, it is visible.
Thanks. So friends, what we intend to cover during the course of next 1 hour 30 minutes is the relevant amendments and practical issues in filing of the tax returns for non-corporates for assessment year 24-25. The broad coverage of the session that we are going to discuss today is basically we'll discuss the tax rates, maybe the key amendments which have been brought in by Finance Act 2023, which would impact our tax return filings. Some other amendments which are not very relevant, but which needs to be kept in mind while we are filing our tax return. So there are some miscellaneous amendments. If time permits, then probably we might shift to the requirement to file income tax returns and the common issues and precautions that one needs to take care, and the changes in the income tax form for assessment year 24-25. So straight away moving on to the subject, I think tax rates, everybody is aware that there is no change in the tax rates under the existing tax regime as compared to the previous year for individuals. However, the tax rates under the new regime, which is also under section 115 BAC, has seen some change. So number of changes have happened in the new taxation regime, where the maximum exemption limit, which was chargeable to tax, has increased from 2.5 lakhs to 3 lakh rupees. The rate of surcharge, which was 37% for income above 5 crores, has been brought down to 25%. So person who is governed by the new tax regime will only pay surcharge of 25% if his income is exceeding 5 crores. Vis-a-vis somebody who is under the old regime will pay 37%. In terms of tax rates, an option now has been given to manufacturing cooperative societies to pay tax at 15% plus surcharge and cess, a provision which is similar to section 115 BAB for normal corporate entities, and a specified provision which is introduced by Finance Act 2023, which provided that winning from any online game shall be taxable at 30% on the net winning, and what is net winning was specifically defined under the rules. So these are the broad changes in the tax rate. Now moving on to the new tax regime, which is section 115 BAC. So BAC was on statute for some time now. However, most of the taxpayers thought it that still, given the provisions, the way it was worded, the way the benefits were granted, it was not very attractive for the taxpayers. And hence a need was felt by the government to amend this section to make it more attractive and make it more acceptable amongst the taxpayers. From the current assessment year onwards, the new tax regime would be considered as a default regime of taxation. So unless you opt out of this regime, this would be considered as a default tax regime for all the assessees. The benefit or the characteristics of this regime is it is simple in nature, easier to comply because there are very few deductions that a person can claim while he's filing his tax return under the old regime. So it is very easy for a common person to file his tax obligations without consulting a lot of people. So maybe he just has to take his gross income and just put it in the software and the return is ready. Lesser deductions, so very few deductions, as we spoke, very few deductions under Chapter 6A are allowed while computing the taxable income. The downside of this new tax regime is because there are very few deductions. There is a low incentive to invest for the taxpayer. So earlier there was incentive that if the taxpayer invested in certain specified schemes, then he would get a tax rebate. This investments was more like a social security at some future point of time. However, with the current regime of taxation, the incentive to invest is no longer there. So as we spoke, the basic threshold limit has been increased to 3 lakhs from 2.5 lakhs. Earlier there were 6 slabs in the new tax regime, which has been brought down to 5 lakhs. So earlier, for every 2.5 lakhs, we had a tax slab. Now it has been changed to every 3 lakhs. So for every 3 lakh, you have a different tax slab. The rebate, which was earlier capped at 12,500, has been now increased to 25,000 for the taxpayer whose total income is up to rupees 7 lakh of rupees. A major change that has been brought in is the standard deduction of rupees 50,000 for a salaried person who is opting for new tax regime. So this earlier standard deduction was not allowed as a deduction under the income from salary. However, they have now reintroduced this under the new tax regime as well. The rate of surcharge is capped at 25% for SSCs whose income is above 5 crore rupees. The entire regime of 115 BAC, which was earlier restricted only to individuals, has now been extended to AOP, body of individuals, and artificial jurisdictional persons. So this was earlier restricted to individuals and HUF. Now the scope has been expanded to cover the other SSCs as well. As mentioned, application has to be made in specified form for opting out of the new tax regime. On the right hand side, we can see the tax rates for each 3 lakh rupees of slab which is there. So taxpayer who has business income or professional income, he'll have to exercise this option whether he wants to remain with the old regime or he wants to shift to the old regime on or before due date to file the income tax return under 139(1). So if he doesn't exercise the option under 139(1), it would be difficult for him to go back to the old regime of taxation if he has a business income. Once the option is exercised, the option of old regime would continue to apply for all subsequent assessment years unless he tries and decides, no, I want to go back to the new regime of taxation. However, this option to enter to the new regime is available only once during the entire lifetime. He cannot every year switch in, switch out to the new tax regime. So from new to he goes to old and from old to new. He cannot switch in, switch out if he has business income. However, in any scenario, if he doesn't have any business income in subsequent assessment year, then the option is available to him to switch in, switch out every year. Exemption from AMT available. So if he shifts to the new regime of taxation, alternate minimum tax would not be applicable. However, whatever is the past AMT credit would not be available as set off against the taxable income. One critical adjustment is the reinstatement of unabsorbed additional depreciation. So assuming you had a business, you had a unabsorbed additional depreciation which is getting carried forward year on year. And assessment year 24-25, the taxpayer opts for the new tax regime. And a one-time window has been given for him to adjust the block of asset. Whatever is the component of unabsorbed additional depreciation would be entitled to adjust to that extent in the block of asset. However, this is with the condition that the option has to be exercised in assessment year 24-25. If the option is not exercised in assessment year 24-25, then this will become like a permanent loss. So assuming you had 100 rupees of unabsorbed depreciation, out of that 10 rupees was unabsorbed additional depreciation. If you opt for the new regime of taxation, then the 10 rupees you can increase your opening block of asset by 10 rupees. However, if you don't opt for the new regime of taxation assessment year 24-25, then the amount of loss or an amount of unabsorbed depreciation that can be set off during assessment year 24-25 would be restricted to 90, that is 100 minus 10. For taxpayers not having business or professional income, they have an option to switch every year, subject to filing of applicable form. However, something which is very critical, that if you look at the language of the provision, it requires that you file the form in the specified format. However, practically, if you go to the income tax portal, then if you don't have business and professional income, there is no requirement for you to file the form 10I-EA. So maybe the Act provides something, but practically the returns are getting uploaded without filing the form. This is basic comparison of the old tax regime and the new tax regime. As we spoke, the limits, the basic income level for rebate eligibility was 5 lakhs, which has increased to 7 lakhs. The rebate amount, which was 12,500, is now 25,000. Because of the standard deduction which is available for salaried taxpayers, the effective tax-free salary income now stands at 5.5 lakh for persons under the old tax regime and 7.5 lakhs under persons under the new tax regime. If you look at the major deductions, in most of the cases for the new tax regime, you will find a cross mark. So none of them are available. The only thing that is available is interest on home loan on the let out property. Even under this slide, you find there are hardly few ticks on the right hand side column, the new tax regime. So one deduction that is allowed is NPS contribution by the employer under 80 CCD 2, and assuming you have a business or profession, then maybe 80 JJAA. These are the few deductions that a person can claim or the taxpayer can claim under the new tax regime. Rest all deductions have been done away with. The idea is you pay tax at a lower rate and don't claim any deductions under the provisions of the Act. A brief comparison, I think we have already discussed this. Maybe this slide is something that you can refer at peace at your leisure. Moving on to the next big amendment which is there, which is the MSME 43B amendment. As everybody would be aware that 43B allows deduction of an expenditure on a payment basis. So basically any expenditure that you do is allowed. First, you will need to pass the test of section 37 from section 30 to 37. If you pass that test, then that expenditure is allowed. However, after passing the first test, you need to clear the second test, which is whether you have respect of certain expenditures, if they are qualifying under 43B, those are allowed only if the payment is made within a specified timeline. If the payment is not made within the specified timeline, then the expenditures are not allowed. Earlier we had certain specified clause. Now Finance Act 2023 has introduced a new clause H, which provides that any sum which is payable to micro or a small enterprise beyond the time limit which is specified under section 15 of the MSME Act would be allowed on payment basis. So basically what the legislature has provided now is sum payable to a micro or a small enterprise beyond the time limit which is specified under section 15 of the Act would be allowed on payment basis. So it is critical to understand who are micro and small enterprise, and at the same point, what is the time limit which has been prescribed under section 15 of the MSME Act. If you refer section 15 says the buyer shall make the payment on or before the date agreed upon between him and the supplier in writing, or where there is no agreement in this behalf before the appointed date. So basically it says that if you have agreement in writing, then whatever is the date agreed between the buyer and the supplier, or if there is no agreement, then the appointed date. Then the proviso says that however, in no case the period agreed between the supplier and the buyer shall exceed 45 days from the date of acceptance and date of deemed acceptance. So first they say that whatever is the agreed terms, we are accepting that. However, the proviso says that even if the agreement is in writing, the maximum time period cannot exceed 45 days from date of acceptance and date of deemed acceptance. And if there is nothing which is written between buyer and the supplier, then the payment has to be made before the appointed date. So let us understand what do you mean by the appointed date, day of acceptance and the day of deemed acceptance. Date of acceptance means the actual delivery of goods or rendering of service. In case objection is raised within 15 days of supply, then the day on which the supplier removes such objections. If you go back, it says 45 days from the date of acceptance. So date of acceptance is nothing but the day on which you receive your goods or the services are rendered by the supplier. And assuming you receive goods, but if you point out defect, then the day on which the defect is removed by the supplier. So that is what is meant by the date of acceptance. Date of deemed acceptance is defined to mean if no objection is made, then the day of actual delivery of goods or rendering of services. So if the goods are delivered and if no objection has been raised, then whatever is the day of delivery of good would be considered as a day of deemed acceptance. And appointed date is defined to mean 15 days from the date of acceptance by a buyer from a supplier. So if we have to summarize the definition of section 15 of the MSME Act, it says if it is in writing, then 45 days from date of acceptance. Date of acceptance is the day of delivery of goods or services. And if there is a defect or any objection raised, then the day on which such objection is removed from that 45 days will get counted. And in case no objection has been raised, then 45 days from the day on which you receive the delivery of goods. And in case where no agreement has been entered into, then it is 15 days from the day on which the goods are received or services are rendered. I hope this definition is clear because this would be quite relevant for you to determine the quantum of disallowance for the current year. And for determining the quantum, it is very important and essential that you know from which date the time period has to be counted. Something which is very critical that we have a proviso to 43B which says that if the payment is made before due date of filing return of income, then there is an extension, then there is no disallowance for those payments. However, this provides the benefit under the said proviso has not been granted to clause H, which would technically mean that if you make payment after specified due date, you have to make payment by 31st March or the specified due date. If you don't make that payment, then those payments will be disallowed for the current year. Also, something which is very critical that this is applicable to all taxpayers having business income, irrespective of whether tax audit is applicable or not. So the provisions of 43B are applicable to all SSEs, irrespective of whether the provisions of tax audit are applicable or not applicable. However, the only exempted category is the category of taxpayers who are offering income on presumptive basis. Because they offer income on presumptive basis, provisions of section 30 to section 43 are not applicable to those SSEs. So we look at the time limit which was prescribed under the MSME Act. Now the second definition, second critical item under what we saw was the definition of the MSME. So payments to micro and small enterprise. Micro and small enterprises have been defined. So the conditions have to be satisfied cumulatively in terms of investment in plant and machinery and annual turnover. So we are considered as micro if your investment is less than 1 crore and annual turnover is less than 5 crore. And you are considered as small if it is less than investment in plant and machinery is less than 10 crores and annual turnover is less than 50 crores. So only for these two categories, the provisions of section 43BH would be applicable. In all other cases, provisions of 43BH would not be applicable. So let us understand the provisions through example. Scenario 1, we are talking of year of incurrence of liabilities financial year 22-23. Due date of payment is Jan 23. Date of payment is Jan 24, which is much beyond the due date prescribed under section 15 of the MSME Act. Provision doesn't apply because the payment relate to earlier year. It doesn't relate to the current year. So the liability which is incurred after 1st April 2023 would be covered by the provisions of 43BH. If the liability was already outstanding as on 31st of March 23, it would not get triggered by the provisions of 43BH. That is what scenario 1 says. Scenario 2, the liability is incurred in the post amendment period. The due date of payment is October 23. The date of payment is January 24. Other provisions of 43BH applies. No. So there would be no disallowance because the disallowance and the payment is within the same year. So if it is within the same year, probably the deduction would be allowed in the same year. So maybe the 43BH, though it technically applies, but practically there would be no tax impact on account of the provisions of 43BH. Scenario 3, the due date is 5th April, which is beyond the financial year. The liability is incurred in the financial year 23-24, but the due date is on 5th of April 24. Actual date is also within the time limit of section 15. Under view 1 and view 2 both, the deduction would be allowed for the same financial year, which is financial year 23-24. Now looking at scenario 4, where the complexity lies. The year of incurrence of liability is financial year 23-24. The due date is 5th of April. However, the payment is made on 1st May 2024. So if you see here, the payment is made beyond the time limit which has been prescribed under section 15 of the MSME Act. Now view 1, whether provisions of 43BH applies. View 1 is yes, because the payment has been made beyond the time limits which has been prescribed under section 15 of the MSME Act. There would be a disallowance under for the year financial year 23-24, and whatever was the amount incurred would be allowed only in the year of actual payment. That is what view 1 is. View 2, it basically states that, so there is a pool of people who have been taking or canvassing a view that whatever is the liability of the MSME D has to be due as on 31st of March for provisions of 43BH to get triggered. If this amount was not due as on 31st of March, then the provisions cannot be tested for that specified year. So for example, in the current case, because the amount is not due as on 31st March 2024, this provisions would not be applicable. This provision of 43BH has to be tested in financial year 24-25. And because in financial year 24-25, I am already making this payment, then there should not be any disallowance. So the view 2 is, because on the day of the balance sheet as on 31st of March 2024, this amount is not due as per the MSME Act, there would be no requirement to disallow the said sum, and the entire sum would be allowed as a deduction. I hope I am clear on this. Now let's look at some controversies which have been there in the MSME Act. The provisions apply to charitable institutions? No, the provisions don't apply to charitable institutions because there are specified computation mechanism and there is a separate code, section 10, 11, 12 for charitable. So they are governed by those specified provisions. Disallowance would be applicable for MAT computation? No, not applicable for MAT computation. Can disallowance be applicable in relation to capital expenditure? So for example, you purchase a machinery from a supplier and the payment is not made within the specified time limit. Whether you disallow the entire capital expenditure or you disallow the depreciation, technically you cannot disallow the amount because what you are claiming is the allowance and not the expenditure. So even if the supplier of a capital asset has not been paid within the specified time limit, there would be no trigger of the disallowance under 43BH. Assume a scenario where you took some services, there was default for TDS compliance and there is also default for payment within the specified time limit. then what happens? Whether the aggregate disallowance exceeds the total sum which is involved, or would it get restricted to whatever is the maximum sum? So assuming 100 rupees is there, then 30 rupees will get disallowed under the TDS provisions, and balance 70 will get disallowed under 43B provisions. You don't have a choice to disallow entirely under 43B, 100 rupees under 43B, and not disallow anything under 40A. That is what my view is. First, 40A will come into picture, and only then you travel to 43B. Whether provisions apply to traders registered under the MSME Act. So assuming your supplier is a trader, whether provisions of 43BH would get triggered, my view is no, because the benefit of registration was given to traders only for the benefit of priority sector lending. There's a specific office memorandum which states this. Therefore, you cannot extend this benefit to traders. At what point of time you need to check the registration of your supplier, whether it is start of the year, end of the year, on the day of transaction. Ideal scenario is on the day of transaction. However, you need to factor in the practical difficulties and the challenges, assuming this has to be done on a daily basis. So maybe end of the year would be a reasonable compliance in my view, but ideal scenario is the day of transaction. What happens if supplier surrenders registration before the year end, and whether disallowance would get attracted? So maybe the day on which you did the transaction, the supplier was MSME, subsequently decided, I don't want to continue with this registration, I'm surrendering my registration. In such case, whether a view can be taken that as on 31st of March, the supplier was not registered under MSME, and therefore 43BH disallowance should not get triggered. In my view, it would be difficult, but not impossible. Maybe with proper documentation, one could argue that yes, no disallowance is getting triggered. What happens to the year-end provisions under 43B? So instead of booking the expenditure under the ledgers, specified ledgers, I book this as provision. So it will all depend on the factual scenario, whether these are actual provisions or you have just shifted your liability from the creditors account to the provisions account. If these are actual provisions, then maybe provisions of 43BH would not apply. Otherwise, yes, provisions would apply. Whether the disallowance would be inclusive or exclusive of GST. Ideally, this has to be excluding GST. GST is just like you are acting as a trustee for the government, so it has to be excluding the GST component. Disallowance would be gross or net of TDS deducted. It has to be net of TDS deducted, because to that extent you have already deposited or paid to your vendor. What is the amount which is pending to be paid is only the balance amount. Whether the due date specified in invoice would constitute written agreement, to my mind, yes, that is sufficient compliance. It would constitute written agreement. Timelines to be checked with reference to bill date or booking date, as discussed. It has to be with bill date, assuming that the GRN and the bill date is one and the same. Otherwise, it has to be from the GRN date itself. In case of check issued but not cleared, will disallowance apply? Arguably no. However, proper documentations needs to be kept in place, and also one need to ensure that sufficient banking facility was available as on 31st of March. So it cannot happen that you had banking facility say of worth 1 crore and you have issued checks worth 15 crores as on 31st of March. So it will look illogical. If with proper documentation and if you have proper banking facilities, yes, you could argue that you had issued checks. Now all those checks have got cleared before 30th of June. So probably there should be no disallowance under 43BH. Provisions would apply to retention money. Yes, provisions would apply to retention money. There is no specific exemption which has been given. So these are all basic day-to-day controversies which are relating to 43B, and I think this would all help you in complying with the provisions of 43B. Next major amendment with reference to non-corporate taxation is with reference to investment in the residential property. Everyone would be aware that there is an exemption which has been provided under section 54 and 54F. So if you purchase a new residential house property, then get an exemption from your long-term capital gain subject to fulfillment of certain conditions. The conditions which are prescribed in section 54 and 54F. Earlier, there was no specified limit which was provided. So whatever sum which was contributed and for the new residential house property, you were entitled to the entire amount being claimed as exemption under 54 and 54F. However, the provisions have been amended now. Now the provisions provide that in any case, the cost of new asset in excess of INR 10 crores shall not be taken into account for computing the exemption. So assuming you purchase house worth 40 crores, maximum what would be allowed is only INR 10 crores. Anything over an excess of 10 crores would not be allowed as exemption from the capital gains for that particular year. And consequential amendments have been made in the capital gain account scheme. So if we look at some issues which are there with section 54 and 54F, the first issue being the limit of 10 crores, whether this is available year wise or total. So for example, if I sell a residential property say in March 24, do I get 10 crore for March 24 and 10 crore for March 25 because the time limits will spread out over a period of 2 years? Do I get 20 crore as limit, or my limit is restricted to 10 crores in aggregate? Two views are there. First view is that provisions do not provide for aggregate deductions. Hence, a view could be taken that yes, 10 crore is eligible year wise. However, if you look at the intent of the legislature and the way the memorandum to finance bill has been worded, the intention is to restrict the maximum deduction to 10 crores. And accordingly, the overall cap of 10 crore would be in aggregate and not year wise. So maximum investment that would be eligible would be only 10 crore rupees. The second question that one would need to answer is whether this 10 crore is cumulative for section 54 and 54F, which would mean that total 20 crore is what you can claim, or is it only restricted to 10 crores? So sections of 54 and 54F are independent and mutually exclusive. You could claim benefit of both. The provisions do not provide that the deductions have been restricted to 10 crores. So basically, you will be entitled to 20 crores in aggregate of 54 and 54F. And with a limit of 10 crores can be enjoyed by each owner, or is it restricted to each property? The provisions don't restrict the amount of property, it caps the exemption qua the SSE. And since it's a beneficial provisions, the limit of 10 crores should be qua each co-owner. Therefore, if there are 5 owners in the property, then maximum what you can claim is exemption of 50 crores against a particular property. Clubbing provisions, whether the cap of 10 crores would apply before clubbing or after clubbing. So in past also we have decisions whether the benefit of section 54 and 54F have to be given prior to computing the capital gain, and only the net income has to be clubbed, or it is the gross income which has to be clubbed. So I think there are a series of decisions. The consensus view is that the benefit of clubbing, the net income has to be clubbed, which is after giving the benefit of 54 and 54F. Therefore, even minors would be eligible for claiming the benefit of 10 crore. In terms of example, if we have to look, first example talks about section 54. The sale proceeds was 40 crores. The index cost 10 crore. Capital gain 30 crores. I invested 30 crore in the property. In the way earlier provisions worked, I would have been entitled to claim benefit of 30 crores. My net taxable capital gain would have been nil. Now under the amended provisions, though I have made investment of 30 crores, whatever is the maximum that I am entitled to is only 10 crores. So out of 30, only 10 goes out. Balance 20, I pay tax as long-term capital gains at 20%. So a major change in the way taxation is worked for HNIs. Similarly for 54F, earlier if I have done investment of 50, which is same as the sale proceeds, then I would have been entitled to the entire exemption. My net taxable capital gain under the earlier regime would have been nil. However, under the new regime, this is restricted to 8 crores depending on the formula. So On the balance amount, I pay tax at 32 rupees under the amended provisions. Let's move on to the next major amendment, which is life insurance. So finance at ULIP provisions were amended in 2021, where they provided that if the premium payable is about 2.5 lakh rupees, then whatever is the excess would be treated as capital gains, read with Rule 8 AD. Similar provisions have been provided for the normal life insurance policies which are issued on or after April 23, where the provisions in a simplicity provides that if the premium that you pay for policies, if there is single policy, then the premium of that policy. If there are multiple policies, then all the premiums put together during the term of the policy, if it exceeds 5 lakh rupees, then whichever policy the sum exceed 5 lakh rupees, from that policy onwards, the sum would not be exempt under section 1010D. The sum would, whatever sum that you receive would be taxable under the normal provisions of the Act. This, and what would be taxable is, this would be taxed under income from other sources, and you, whatever premiums you have paid, you would get deductions, so provided that you have not claimed any benefit under any other provisions of the Act. However, a proviso has been provided that even if the premium that you pay exceed rupees 5 lakh rupees in multiple years, however, if the amount is received on death of the person, then it still continues to enjoy the exemption under 1010D. There would be no taxability on this kind of income. And a circular 15 of 2023 has been dated 16th August, where almost like 16 examples have been provided to provide clarity on the taxation of life insurance policy. So I would request each one of you to go through this circular, which would make you more clearer as to how the taxability of life insurance policy will work. So as we spoke, it is applicable to each policy. If you have multiple policies, then you need to look at on an aggregate basis. So there would not be a situation that, assuming your premium amount is 5.5 lakh rupees, and part policy it will arise, part policy it is exempt, part is not exempt. It is only full policy that you need to consider. So either your policy will enjoy the benefit of 1010D or it will not enjoy the benefit of 1010D. And what has been clarified, a relevant clarification has been made that premium payable for 5 lakh rupees, the premium that we need to consider is to be exclusive of the GST. It is not to be inclusive of GST. Let's look at the illustrations which have been provided. So date of issue is April 23. Premium is 4.5 lakh rupees. Sum assured is 45 lakhs, and consideration received is 1 lakh, is 52 lakh rupees. So in scenario life insurance policy A, it would be exempt because it is issued after April 23. Premium amount is less than 5 lakh rupees. No restriction at all. 1010D benefit is available. If you look at policy B, A plus B put together, the premium amount exceeds 5 lakh rupees. Individually also, the life insurance policy exceed 5 lakh rupees, and therefore this consideration received of 62 lakh rupees would be considered as taxable, and no exemption would be available. The next scenario, where we have 4 policies. The first is issued on April 22. Premium amount is 5 lakh rupees. Consideration is received 60 lakh rupees. Would be exempt because the policy is issued prior to April 23. So any policies which the taxpayers have taken prior to April 23 would be grandfathered. The exemption under 1010D would be continued to be available, subject to the other provisions of the Act. For life insurance policy A, the exemption would be available because it is less than 5 lakhs. B, it would be available again because it is less, A plus B put together is less than 5 lakhs. And C would not be available because individually it is exceeding 5 lakhs, and also A plus B plus C is exceeding 5 lakh rupees. So if you put all the 3 policies together, it is exceeding 5 lakhs. Now, next scenario, where all the policies are issued post the amendment period, The annual premium is 4,50,000. The sum assured is 40,50,000, and the consideration received is 50 lakh rupees. Now, in this case, because the sum assured is more than the 10% of the annual premium, or rather, the premium is more than the 10% of the sum assured, the maturity amount of 50 lakh would become taxable. So, not only you need to see uh, the condition of 5 lakh rupees qua the policy, you also need to check whether the other conditions which are prescribed under 1010D for claiming the exemptions are satisfied or not. Now, coming to life insurance policy A, because the policy A is issued in April 24, you need to now aggregate policy X plus policy A. If you do a combination of two, the annual premium exceeds 5 lakh rupees, and therefore all the three policies, policy A, B, and C, would become taxable. So, for all the four policies, tax will have to be paid at the time of maturity, and no exemptions will be available under 1010. Next example is your policy X, where you can claim exemption because it is less than 10% and less than 5 lakh rupees. Next is whether you claim exemption for life insurance policy A or policy B, because premium is for life insurance policy is A is 2 lakhs and for B is 2.5 lakhs. Both put together will not exceed 5 lakh. So if you put policy X plus A, it would be 4.5 lakhs. If you do X plus B, it would be 5 lakh rupees. In any case, it is not exceeding 5 lakhs. The question that we need to ask is whether I have an option to select which policy I claim the exemption, or is it something that I need to go sequentially. The circular very specifically provides that whichever is the more beneficial policy for the SSE, the SSE might go with that life in exemption. In this case, because 38 lakhs would be more, I'll claim exemptions of a higher amount under 1010D for life insurance B and make policy A and policy C taxable. So the exemption would be available for X and B, and A and C would be subjected to tax. So maybe there are much more complicated examples in the circular. I would request each one of you to go through that circular, which will make things more easier for you. Market linked debentures. So in past, there have been securities where the underlying principal component was debt. However, the return of those securities was linked to the market, and the taxation was considered as long-term capital gain based on the way the structuring of that unit was done or that instrument was done. However, to plug that loophole, a new section 50AA has been introduced, which deems that capital gain arising from short-term capital asset would now be taxed at a regular rate. So earlier this was subjected to long-term capital gains. Now this would be treated as short-term capital asset and taxed at regular rates. Section 50AA overrides Section 242A, Section 112. However, no amendment has been provided in both of these sections. So 50AA is a notwithstanding provisions and overriding both of these provisions. The provisions would be applicable to transfer, redemption, and maturity, all three of them. The computation would be done in the manner of full value, less cost, and any expenditure that has been incurred on transfer or redemption or maturity of the MLDs. Most importantly, no benefit of indexation would be available because this is a deemed capital gain. Whatever is the net difference, you will pay tax on the entire sum at the applicable rate. Now, because the provision is similar to Section 50 and deeming this to be short-term capital gain, we have seen in the past that judicial authorities have held that if otherwise your asset was a long-term capital asset, where period of holding was 12 months or more, you would be entitled to claim benefit under 54 EC and 54F. There are certain decisions which provides for that. Maybe based on that, one could argue, even though it is taxable under 50AA, I would be entitled to claim benefit under 54 EC or 54F as may be applicable. So these were some key amendments that I thought would be relevant for all of us and would be relevant in our day-to-day filing of tax returns. Now there are certain amendments which are not very relevant, not very critical, but maybe relevant for our tax filings as well. So first is the change in the limit of section 44 AD and 44 ADA. Earlier, the limit was 2 crores, which has now been increased to 3 crores for eligible businesses, and provided to certain conditions that the amount received in cash does not exceed 5% of the total turnover or gross receipts for the previous year. So if you satisfy this condition, then probably instead of 2 crores, you get a extended benefit of 3 crores. In terms of professional, the earlier limit was 50 lakh, which is now increased to 75 lakh rupees. What is to be seen is aggregate amount which is received. Now, the definition is similar to 44 AB, where the limit is increased from 1 crore to 10 crores. Over there, the benefit is cash received and revenue received both. So probably you could take an argument over here that it will include capital receipt also. So this is amendment with reference to electronic gold received. Now it provides for exemption for conversion of physical gold into EGR and vice versa from capital gains. So if you have gold, you can go and convert your gold into electronic gold received. There would be no incidence of tax. You would enjoy the benefits of interest and all other things. And whenever you require physical gold, you could go back to the authority, give your EGR receipt, and convert that electronic gold receipt again into physical gold. The conversion of gold into EGR has now been regarded as not to be regarded as transferred under section 47. The cost would be the original or the historical cost as per section 49. Period of holding will go back to the date of original gold on which you hold the physical gold. So assuming I hold physical gold on say April 2001, I converted in 21 and subsequent reconversion happened in 24. The date of holding will go back to 2001 and not to 2024. The benefit has been provided for the gold, but what happens to the EGR? So I directly trade out my EGR. So I go and submit my physical gold, get an EGR. But if I sell my EGR itself, whether this would be taxed at 20% with indexation or this would be taxed at a lower rate. So EGR has been defined as a security under the SCRA Act and is also liable for payment of STT to my limited knowledge. So my view is that what would be applicable is lower of 10% without indexation or 20% with indexation because it's a listed security. No double deduction. So for interest on housing loan. So earlier there was instances were observed where people claimed deductions under section 24 and also claimed the same interest as deduction under section 48 while computing the capital gains income. In this, there were two scenarios. One scenario was interest which was not allowed as 24 because you have a upper limit of deduction under 24B. Whatever was over and above that, you capitalize that as part of cost of acquisition. That was perfectly all right. However, the second scenario was where you claimed under 24B and the same amount you again added it to the section 48. Such kind of scenarios are now thought to be restricted, where they specifically provide that if you have claimed deduction under any particular section, then you will not be entitled to the same under any other provisions of the Act. Intangible assets and other rights. So we already have a definition under section 55 as in respect of certain assets like goodwill, tenancy. It has been provided that if no consideration has been paid, then the cost of acquisition has to be considered as nil. However, the taxpayers in certain cases argued that in respect of other assets which were not defined in section 55, a position was taken that because it has not been defined, the ratio of Supreme Court in case of BC Srinivasa Shetty would apply. And as the cost is not determinable, there would be no capital gains tax that would accrue in that cases. To overcome that scenario, an amendment has been brought in section 55, where they say that in respect of intangible assets or rights which are not defined in section 55, and where no consideration has been paid to acquire those assets or those rights, the cost would be considered to be nil. So these are basically the self-generated goodwills or the self-generated rights that the amendment sought to cover, and would be applicable to all SFCs from the current financial year. Receipt on issue of shares. So where a company issued shares to a resident at a price which was higher than the fair market value, then whatever was the difference between the fair market value and the price at which shares have been issued, the difference was subjected to tax in the hands of company under section 56(2)(7)(b). The provision was earlier applicable only in case of a company where public are not substantially interested, and when the shares were issued to a resident person. Now the provision provides that these provisions would also be applicable to non-resident person. Because this provision has now been extended to non-resident, the CBDT has provided or added 5 methods under Rule 11UA to determine the fair value of shares which are issued to non-residents, and those 5 methods are comparable company multiple method, probability weighted expected return method, option pricing, milestone, and replacement. So basically providing more flexibility to the taxpayers to determine the fair value in accordance with the international best practices. And if the shares have been issued in accordance to this specified provisions, then there would be no issues. You could issue shares and there would be no taxability under 56(2)(7). Online game winnings. So earlier there was no distinction between offline game and online game. Whatever was the winnings from the games was taxable under section 115BB at the rate of 30%. And the withholding happened under 194B at 30%. Now a new section has been provided, 115BBJ, which provides for taxation of net winnings from online games. So to cater to the online games, because this is more prevalent in today's time, where a lot of games through computer resources or internets is what the younger generation is using. To tap those kind of winnings, a specified provision has been provided. What do you mean by net winning? A detailed rule has been prescribed under 133, which computes the net winning from a particular online game, and that is the income that has to be offered for the purpose of taxation and would be taxed at 30%. The provisions of the TDS on the net winning is applicable from 1st July 2023. So these were the few amendments that were relevant and would be applicable for the returns that we would be filing for last assessment year 24-25. Now, filing of income tax returns. I think most of you would be filing tax returns and would know answers of this. First is as non-resident. I'm not covered what is the time, what are the basic limits and who is required to file, because I presume that this would be something that be known to all of us. However, posing certain questions, whether in such a scenario, whether you would be required to file tax returns or no. First scenario is where senior citizens having taxable income of 3.1 lakhs under the old regime, yes, would be applicable to file the tax return, because for non-resident, limit is only 2.5 lakh rupees, he would be required to file. Second is individual having gross total income of 3 lakhs and deduction of chapter 6A of 2.5 lakh rupees. So Sahil, how much more time do I have?
Sir, you have time till 5 p.m.
Okay.
So just I
So
want
for
to
question
know.
answers, how much time we need to give?
Yeah.
To
So there
give
are 44 questions in our list. So I am planning to take at least 10-12 questions so that all can be benefited large. That's why I just
So
want to know by how much
yeah, so
time
maybe
you
what
and
I
your
can do is
people.
I can finish by 4:30, and maybe half an hour we can have question answers.
Yeah, no worries. Definitely, we will do
Yeah,
that.
yeah. So I can skip
Yeah.
this slide. Maybe this is something that most of us you would be aware.
No, take as per your requirement. I just want to know that so that I can plan accordingly and we can take maximum out of it.
Yeah,
That's why.
okay.
Thank you very much.
Yeah. So I think let's go to the consequences for non-filing of return. One is the late fee of 234F would be applicable 5,000 and 1,000 depending upon the slab of income that you have. Interest under 234A would be applicable for at the rate of 1%. You will not be entitled to carry forward your losses. There could be assuming non-filing is seen as tax evasion, then also imprisonment of for 6 months to 7 years. There would be a loss of interest, and probably you would be classified as a non-filer, triggering provisions of Section 206 AB. And for all payments that you receive, there could be a tax incidence of 20%. Some common questions or something which is very relevant. Schedule assets and liabilities. For non-resident and not ordinarily resident, only assets which are located in India needs to be reported. For ordinary resident, there would be an overlap between Schedule AL and Schedule FA because at both instances you need to report this transaction. However, the question that generally comes up is whether what is the value that you report, whether you report cost, whether you report market value, or whether you report a step-up cost as per Section 55. Because in case of certain assets, you get an option to increase your cost base based on the value as on 2001. So you have an option to increase this value. So whether you report the step-up cost. In my view, it would be the cost, neither the market, it should be the cost that needs to be reported, not the market value or the step-up cost. In case of gift will, where the property becomes property under the gift or will, then provisions of 49(1) would be applied. Whatever is the cost of the previous owner would be applicable, and that needs to be reported in Schedule A. Something that is very critical that one needs to understand is only specified assets and specified and corresponding liabilities needs to be reported. It is not that the entire personal balance sheet has to be reported. Only specified assets which have been listed down, that needs to be reported in Schedule A. Schedule of foreign assets, mandatory for taxpayer who has income from, who holds any assets outside India, has any signing authority, or has any income from any source outside India. So if you are a resident and ordinary resident, if you have any 3 limbs which are getting triggered, either of those limbs, then you are required to disclose, schedule those assets in your Schedule FA in your ITR. What happens in case of split residency and dual residency? These are concepts under the double tax avoidance agreement. There could be a scenario that maybe under the domestic tax provisions you are a resident, but by virtue of the double tax avoidance agreement, you become a non-resident of India, you become a resident of some other country. Currently, the way things are, the provision to report Schedule FA obligation is there if you are a resident, your residential status is RNOR as per the domestic provisions. So even if you are a dual resident or non-resident as per the DTAA, the suggestion would be you need to report Schedule FA in your ITR. Something which is very critical is reporting is required even if the asset is held for a single day during the relevant accounting period. So even if you bought today morning and sold it in the evening, still the reporting is applicable. It is not required that the asset has to continue for the entire period. The reporting has to be done calendar year. This is the biggest challenge which we face. The income have to be reported for the financial year. However, the reporting of the asset is for the calendar year. So for example, if you are reporting for the financial year 24-25, financial year 23-24, March 24 returns, 1st January 23 to December 23. This is the time period the assets and the income of the foreign asset is what has to be reported in ITR of March 24. Because the data which you receive from the foreign country is on a calendar year basis, the information which is sought in Schedule FA is based on the calendar year and not based on the financial year. There would be some additional workings that one need to prepare, but I think one need to be extra cautious while filling the Schedule FA. If you hold any foreign asset and if you fail to disclose or there is a non-disclosure, then the implication is there under the Black Money Act. There is a penalty of rupees 10 lakhs with the exception for some bank accounts where the monetary balance is less than specified sum. The foreign assets have to be reported in INR terms. So even if it might be in euro, it might be in dollars. How do you need to convert? The conversion rate is as per the telegraphic transfer buying rate. It has been prescribed which TTBR has to be considered for conversion of the foreign currency into the INR value. Some issues which are reference to the foreign assets. What happens to the jointly held foreign assets, say bank account? Whether you disclosure is required by both holders or only by one, because generally in bank accounts we report only in the first name. Whether you disclose under both the names. Recommended to disclose under both because there is no harm in additional reporting. Disclosure by one may not absolve the other from the liability. So for example, if one reports, you might argue that one has already reported, there is no non-disclosure, but that is not absolving your liability. The liability of 10 lakhs could arise to the second joint holder. Because practically what we have seen is the financial institutions, when they send the data back to the Indian authorities, they report both the joint holders. So it is preferable that both the joint holders report this in their income tax returns. What happens to the reporting of assets which are located in IFSC? So IFSC is International Financial Service Center, which is located in Gujarat. For FEMA purposes, this is considered to be a non-resident area. So whatever payments and receipts that you do have to be done through an LRS route. However, for the purpose of income tax, this is not to be considered as foreign assets because this is within the territory of India and no disclosure would be required under Schedule F. What happens if minor owns a foreign asset whose income is getting clubbed with the father? Is minor required to file a tax return? Because we saw in the earlier slide that if you hold any asset outside India, then you are required to file tax return. So if minor who doesn't have any other income, but he holds certain foreign assets, whether would be required to file tax return? I would presume yes, the minor would be required to file the tax return. ROR has earned income from foreign sources during the year. Again, yes, he would be required to file because there is some foreign income which is getting. So even if it is below the minimum threshold, the requirement to file tax return will continue to apply. What happens to disclosure of stock options? So I think in stock options, there are three stages which are there. One is the grant, second is vesting, third is exercise. So at the grant level, there is no requirement to disclose anything in Schedule FA. At the time of assuming the options have got vested, then same needs to be reported. And if the options are exercised, then again the same needs to be reported in Schedule FA. So vesting and exercise of options reporting would be applicable. If the options are only granted, then there would be no reporting which would be applicable. Something again very critical is in a lot of corporate entities have foreign bank accounts. So assuming you have a company in India having operations outside, maybe that one of the directors would be a signing authority in that bank account. Now he might have left that organization, he might have left that employment, but he is still required to report that bank account in his income tax return. So it would be very difficult for him to get the relevant details and furnish in his income tax return, but that's how the provisions have been worded and one need to comply in law and in the spirit. For legal hire of deceased person can file return on his behalf. So you need to add as a legal hire by submitting required documents. The department will check, and then once the documents are checked, they will disable the online functions of the PAN of the person who has deceased, and then the return can be filed. So the deceased person login will become deactivated once the legal hire option becomes activated, and for that specified filing needs to be done with the department in with uploading of certain documents in the prescribed format. Reconciliations of informations with AIS. So I think this has become very critical now. More and more information is what the department has been trying to capture in the AIS over a period of time. Initially, it were very few. Now, almost like 57 types of incomes and expenses are available in AIS. Few notable I have been listed down in the slides. But as the time progresses over the years, we will see that a lot more information is added in this AIS. And it would be very relevant and important for all of us to try and reconcile those informations with the data that we are receiving from our clients. Precautions. I think we'll take up precautions and then probably we'll keep the floor open for question and answers. So the first so filing of return in the correct income tax form is something which is very critical because wrong selection can lead to return being treated as defective. So if you assuming ITR 2 is applicable and if you file ITR 1, then this would be treated as a defective return. You'll have to file your tax return again. In case of co-ownership, the share of house property is to be filled. So assuming there are two co-owners having 50-50, then you need to mention this in your ITR. Gross rental have to be reported. So assuming the total rental is say 10 lakh rupees, 5 lakh received by A, 5 lakh received by B. First, I have to report the gross rental, which is 10 lakh rupees. Then I have to report my share, which is 50% in the ITR, and the details of the co-owner in the income tax return. Ensure that the losses of previous years are correctly brought forward and set off. So assuming you have some losses which are carried forward, then those losses are brought forward correctly and have been set off correctly in the current year. Ensure that all the deductions are filed in the relevant head and not clubbed under any head. So maybe wherever separate disclosure requirement is there, you are putting those informations in the income tax returns at relevant schedules. If your income is above 50 lakh rupees, ensure that you are filling your personal balance sheet and not your business balance sheet in Schedule AL, because in past we have seen certain instances where Schedule AL, you find all the business assets being reported. What is to be reported in Schedule AL is only your personal assets. Business assets, already there is ITR BS and ITR PNL, which is there for reporting. Where books of accounts are not maintained, so assuming you are going by the presumptive scheme of taxation, then there are 4 fields that needs to be reported. If you are opting for that, then the specified figures needs to be reported. Not sure. In case the taxpayer is partner in any firm or director in a company, then complete details about the partnership firm and the company needs to be reported separately. In case the taxpayer is holding unlisted equity shares, then the day on which he has purchased, at what value he has purchased, whether those shares are transferred during the year or whether those are sold during the year. Complete details of that unlisted company and the shares that you are holding have to be furnished in your tax return. In case where taxpayer earns agricultural income, then he has to report the gross income and the gross expenditure. What we have seen in the past is people generally report only the net income, not reporting the gross income and expenditure at gross level. Also, if you have income which agricultural income which exceeds 5 lakh rupees, then detailed information needs to be given about the agricultural land, its measurement, and various other details have been called for in that specified schedule. Details of exempt income needs to be properly reported. So, for example, if you have certain income which is exempt under the provisions of DTAA, then the same needs to be reported in Schedule EI. Your buyback income, your income from NSC, PPF, your 1010D maturities, all of this would get reported in Schedule EI. Make sure all the bank accounts are pre-validated on the income tax portals and the details provided in the return are correct. Bank is linked with PAN for refund reissue process, because I think what we have observed in last few days is that if none of the account is pre-validated, your return doesn't get uploaded. So I think now it has become mandatory that one of the account had to be pre-validated. Only then your return will get accepted. Disallowances made in the tax audit report should be taken into account while calculating total income. Maybe not applicable for corporate non-corporate assessees, but might be applicable for corporate assessees. Impact of past assessments should be taken while preparing current year's return of income. The data is captured properly long term because the rates of taxations are different for long term capital gain and short term. So the schedules are filled in properly. The rate of taxation would be determined accordingly. So, for example, if you have some securities which is taxable at 10% without indexation, and if you put it in the category of with indexation, the entire net output that will come to you will be very different. So filling the right schedules would be very relevant, especially in terms of capital gains. Your income and TDS ought to match. Very essential that you reconcile your TDS with the income that is being offered, and assuming you're not offering your income in the current year, the proportionate TDS needs to be carried forward to the subsequent assessment year. Ensure that your email ID and phone number is updated in my profile, because the correspondence will come, assuming there is assessment or if there is any other communication, this will come through email ID and phone number. So if these are not updated, you might get some defective notices or some other reminders, and that might remain unanswered. In addition to, I think what we have discussed, I'll take 5 minutes more, Sahil. Some changes in the tax return forms. Earlier, we had an option to select which bank account we wanted refund. I think now that option has been done away with. We have to just mention the details of bank account and ensure that all bank accounts are pre-validated on the income tax portal. In any one of the bank account, you will get a refund of the money. For non-resident, the credit would be done only in the non-resident ordinary account, which is the NRO account. If there is any other account which is being pre-validated, you will not receive the refund. In the ITR form, now a specific disclosure is there for mentioning the due date for filing return of income. Earlier, this field was not applicable. From this return season, we also have to mention that what is the due date which is applicable to the taxpayer while he files his tax return. For Schedule 80DD, so people with disability, I think details of expense for treatment of disabled person. A complete new schedule has got inserted, where they are calling for a lot of additional information like UDID number, Form 10IA, just to ensure and check whether the deductions that a person is claiming is correct or not. So more and more checks and balances are brought in to check whether any incorrect deductions have been claimed by the assessees. Similar thing has been brought in for Schedule 80U as well. So you need to provide the similar details like Form 10IA. In most of the cases, what we have seen that Form 10IA, generally people don't obtain a fresh 10IA every year. Generally 10IA comes with a end date, which is issued by the doctors. They will generally prescribe that 10IA is applicable for a particular date. They will say this is applicable till March 24 or March 25, whatever date. On expiry of that date, people still continue with the old certificate. They don't go to the doctor or a hospital and obtain a fresh certificate. That is where the problem lies. I think with this specific schedule which is getting inserted, I think now it would be mandatory for the people who are claiming this benefit to go and get an updated Form 10IA at a regular intervals. Additional details or clarifications have been sought from the for donations or contributions to political parties, whether the contribution is in cash, kind, and if it is online, then the NEFT details or the RTGS or the UTR numbers. Basically, they want to try and check how is it that you have contributed to the political parties. So I think yes, this is all from my side. Maybe I would have hurried through the presentations at the second half, but I think it would be more relevant for me to answer the questions that have been posted by the participants and share this presentation with you, because this would act as a ready reference. Once again, I would like to thank the Direct Tax Committee for giving me this opportunity to share my thoughts. And in case there are any questions now, I think, Sahil, we can take up those questions at this point of time.
Yes, sir, definitely, definitely. Thank you very much, sir, for this session. I think all the audience might get satisfied, and now it's time to have a Q&A round. So I have received approx 65 questions in my link. We can take up 10, 12 most relevant questions.
So can I
And
see
I
those
think, sir, you
questions?
are,
Is it possible for
sir,
me to
actually,
see?
sir, I will ask the team to share you the link, then you have to log into it to see all the questions.
Because it would be
So
easier to answer that because
I understood, I completely understood. So I request Rudrakshi ma'am or from DTC committee to share that link.
Okay, I'll share the link with. So,
maybe
meanwhile,
till
so
till till, till that time,
Meanwhile,
maybe
sir,
Sahil,
we
you
can,
can ask
yeah,
few
meanwhile,
we
you
questions.
can,
just start the questions. Sahil, sir.
meanwhile, we can take one or two, 3 questions.
Yes, yes,
So,
yes.
so the one question came, if a person is receiving family pension arrears, how is it to be treated? The amount to be of arrears is 8 lakh rupees. So, it is a question asked from Rajkot by Preeti Lalchandani ma'am. The question is, I am repeating again, if a person is receiving family pension arrears, how is it to be treated? The amount of arrears is 8 lakh rupees.
How is it to be treated as in? So you are trying to understand whether there will be some benefit for the arrears or no.
Maybe I think this is the crux of the question only, because whatever I
I
orated,
think
this
for
is the
arrears
question
there is
mentioned.
certain specified formula which has been prescribed for claiming the rebate. So we need to look at those specified formula. Also, for pensions under the new tax regime, now there is a standard deduction of 15,000 rupees. So if you are receiving family pension and if you are under the new tax regime, then you would be entitled to claim an deduction of 15,000. Maybe the question is not clear, but if the question is with reference to calculation of rebate, then I think there is a specified formula which has been prescribed under the act.
Okay, sir, thank you. So we can take up next question. Next question is, consider a case where employee has lease agreement between employee and owner with owner of property and submits the same to his employer. The employer pays this monthly rentals on behalf of its employee and also pays tax on such purchases. This tax on purchases is added to the income of the employee. Can this amount be claimed as exemption? So, can I repeat again?
Yeah, so I think it is tax on non-monetary perquisite that is being asked.
So I will repeat the question again. Consider a case where employee has lease agreement between employee and owner with owner of property and submits the same to his employer. The employer pays his monthly rentals on behalf of his employee and also pays tax on such. I mean, it is like that the owner is paying rent on behalf of employee to someone else. So is this be considered as a perquisite and it will be taxed, or what is it? And what is the treatment of this arrangement? I think this is
So I
what is
think if
asked.
tendency, if the benefit is claimed, then probably I think there would be a grossing up of perquisites which will happen, and then basically the employer will bear tax on it. Then there would be exemption which would be available to the employer. Then this income will not get taxed in the hands of employee, and the employer will not get that deduction. If it's a tendency issue which is there.
Okay, fine. We'll take up next question. While updating ITR 2, please let us know the requirements to provide details of unlisted shares on the case of just bought and hold.
So even if you have bought and sold the unlisted shares during the year,
Bought and hold means they
bought
have
and hold,
bought.
yeah. So you will have
Yeah.
to report what is the date on which you have purchased, and if you are hold, then it. So basically, the table is opening, purchase, transferred, and closing balance. It is like the total summary that needs to be given in the specified schedule.
Okay.
So Sahil, I can read the questions now. Maybe I can take it up.
Okay. Fine. So
So
over to you,
question
sir. You
from
can take the questions and yeah.
yeah, the questions. So do I start from question one or I go from downwards?
No, sir. There are 65 questions. So you, as per your opinion, you will take up the most relevant one, and
Okay, okay.
because every question cannot be answered, I think it is not possible to answer each and every question. Yeah.
So the issues for So Raja Rajan is asking what are the issues for partner filing his individual return when he has other source of income. So issues while partner is filing his individual when he has there are no specified issues which are there. However, one issue that comes to my mind is the benefit of 44AD, that whether partner can claim on the partner's remuneration or no. That is an issue which I think the Madras High Court itself has given a verdict that you cannot take benefit of 44AD or 44ADA on the partner's remuneration. So to that extent, maybe that's the only issue which is there. But other than that, I cannot think on any other issue. Ganesh is asking, where do I show my non-resident salary? Neither it is exempted income nor taxable under any head. Ganesh, it would be either whatever salary income that you receive, either this would be taxable or not taxable. It cannot happen that it is not taxable also and it is not exempt also. Depending upon if the income is accrued in India, arised in India, received in India, if any of the three conditions are getting satisfied, then you will have to report this appropriately in your income tax return. So Rahul is saying in estimating time for tax return preparations, a lot of time is spent in complying with TDS, which is one input that goes in ITR both for corporate and non-corporate. Yes, I agree, Rahul, but you don't have a choice. You need to ensure that you do a reconciliation of your TDS with your books of accounts, because there could be an instances where certain incomes have not been reported properly in your books, which you might come to know only based on the 26 AS report. So it is always essential that you do a reconciliation and then only you file this. One question is what if there is a difference between HRA exemption claim in the ITR and Form 16? I feel what will be the issue? I feel you will receive a clarification notice from the department asking to justify why there is a difference. Initially, they would try and reject this. Subsequently, there would be a clarification. If you reply satisfactorily, then the chapter will get closed. Otherwise, there is high possibility that you might be subjected to assessment under the relevant proceedings. 80U is not applicable under the new scheme. So there is one question from Rohit. Taxpayers not having business professional income, then no need to file Form 10I for going for old scheme, right? Yes, Rohit, you are right. So the provisions of 115 BSE require you to file Form 10. However, practically, if you go to file this form, you will not be allowed to file the form. It allows only if you, in case where you have business income or professional income. If any person showing his income chargeable to tax here. So Shiva is asking if any person showing his income chargeable to tax under new regime for the current year, for next year, can he opt for old tax regime? Shiva, yes, he can opt for old tax regime. If he is a salaried employee, he can switch in, switch out every year. However, if he is a person who is having business income, then he can switch. However, the option to re-enter would be available only once during the lifetime. What are electronic gold receipts? So I think few years back there is a concept of EGR which has got introduced. So people who have physical gold, so maybe the trust or any other specified individuals, they can go take their physical gold and submit this physical gold to a specified authority. equivalent to the physical gold that they have submitted, they will get a receipt which will specify the quantity of gold that they have submitted. The EGR, this is like a fixed deposit or a mutual fund which is there. On the EGR, you will be entitled to interest, which is currently, I think, 2.5% per annum, and whatever is the appreciation in the gold price. So tomorrow, if you want to reconvert your EGR into physical gold, you can just go to the market or to that specified authority, submit your receipts and get back that much of gold. So instead of your gold being unutilized, you are utilizing that gold for generating some income during this period. For claiming deduction under section 80 double D, form 10IA has been filed for AY 23-24. Is it required to file again for current assessment year? Richa, yes, you will have to file it and maybe put appropriate disclosures in the ITR form itself. Prashant is asking, do we have any upper limit to claim interest on home loan in case of let out property in the new tax regime? So per se, there is no restriction. However, the maximum loss that you can set off from house property is restricted to 2 lakh rupees. It cannot exceed 2 lakh rupees. The second question that Prashant is asking is, can we opt for new tax regime if by error opted to old regime in financial year 23-24? So 23-24, if you have already selected that you want to go to the old regime, then for the same financial year, you cannot change the tax regime. So once you have already filed your form 10IEA that you want to get governed by the old tax regime, and for the same financial year, you will not be allowed to file a form to withdraw your application from old regime to the new regime. Where to show sale of rural agricultural land in return of income? Probably under the exempt income category, because I think that income is not some captured anywhere. So I think that is where you would be able to capture it. So I think a lot of questions are with reference to sharing of presentation. The presentation will be shared with the DTC team. I think they will share this presentation with all the participants. LLP having a turnover of 60 lakh is required to get audited under the LLP Act, not under the IT Act. What shall be the due date for filing of ITR of such partners? Due date would be 30th September. Sorry. How to calculate profit loss on sale of cryptocurrencies as only trade statement is available. So now you also have a concept of TDS on cryptocurrencies. So basically, you do a reverse calculation and try and find out what is the value of what is the gain on the cryptocurrency that is there. Also, what is relevant is there is a specific provisions under the I don't recollect the exact section, but it provides that a loss of a particular cryptocurrency cannot be adjusted against the gain of another cryptocurrency. So if there are two cryptocurrencies A and B, the gain of A, you will have to pay full tax. The loss of B, which would be there, will not be allowed to set off against the gain of A. It has to be computed on each. The only gains are taxable. The loss are not allowed to be set off unless the gain and loss pertain to the same cryptocurrency. Long-term capital gain on buyback of shares. Komal, this has to be disclosed under the Schedule EI, which is exempt income. What are the consequences of non-disclosure of information like company shares, directorship, partnership? Currently, there are no penal consequences as such, and we have not seen any action being taken. But I think in terms of if there is an assessment or if there is any action that department wants to take, there is always a general penalty clause which is there under the act. The department or the assessing officer could invoke that and ask you to pay that much of penalty. In case of minor income clubbing, whether father needs to add his minor PAN at income tax login portal or directly claim TDS. So under the schedule TDS, I think there is an option which is given whether the TDS represent is in your PAN or in somebody else's PAN. If it is in somebody else's PAN, then you need to give a separate reporting under the TDS schedule. For non-residents, immovable property need to be disclosed in AL if the taxable income is crossing 50. Also, Rajesh ji is asking whether 50 lakh has to be seen only the Indian income or the global income. So if you are a resident and ordinary resident, then the global income. But if you are a non-resident, then only the Indian source income has to be seen. If the Indian sourced income is above 50 lakh rupees, then all the assets of which are situated in India have to be reported. Otherwise, there is no requirement to report assets in Schedule A.
Are you taking some more questions or?
I am just looking at the relevant questions. So few of them are general remarks. So if the employee's salary do not exceed the taxable limit, does the employer still have to file 24Q return? Technically, yes, because if you have to give the Form 16, then it has to be generated through the website only. However, the rule does not prescribe anything specific. However, what we have seen is that if you are reporting the salary income, and if that person's PAN is, if that person is a non-filer, then you are getting a notices for 20% short deduction under 206 AB. So maybe then it would be a catch-22 situation for you. You need to plan your affairs properly. In tax audit, ITR 3, can we declare lower of 6% under the new tax regime? Lower of 6%. Sure, what the question is. So Keshav is asking if assets and liability statement for income above 50 lakh, whether the value will be cost or market value, it would be cost. However, when you report Schedule FA, generally the experiences have been the financial institutions or the reporting agencies in the other countries generally report the market value. So maybe while reporting in Schedule FA, you might consider market value. However, for reporting under Schedule AL, it has to be cost. At the time of vesting of RSUs, the company sells some shares towards payment of income tax while filling up details of foreign assets in ITR 2. Under items, date of acquiring interest and value of initial, do we have to show only net value after the sale of those shares? Ideally, it has to be gross. Jayachandra ji, what the company try and do is, because there is a perquisite tax which is there, to cover the perquisite taxation, they will sell some of your shares to cover the tax liability so that there is no hit on your taxability. To that extent, you will have to report gross of RSUs and declare accordingly. Sunil is asking if I filed return under old regime and if it is selected for notice, can I change to the new regime for updated return? I don't think you have that option, Sunil. Once you receive some clarifications or a notice being issued, then under updated return you cannot change the regime of taxation. Also, I think the first issue would be you will not be able to file an updated return itself. Due date for filing IT return for LLP which undergoes audit under LLP is only 31/10. Yeah, it is 31 October and not 30th September. Resident SSC is holding cryptocurrency as on 31st December 23. Whether same is need to be disclosed in FA schedule, if yes, under which clause? So if these are crypto of some foreign countries, then you need to disclose in schedule FA. If these are Indian based crypto, then there is no requirement of reporting. So Prakash ji is asking if turnover of the firm is 2.5 crore, loss is 25 lakh rupees, and 95% of transactions are through banking channel. Whether audit is compulsory under 44A, if you go and fall under 40, because 95% are banking transactions, the limit of 3 crores would be applicable. 44 AD, then probably no requirement to get your books audited under 44 AD. Professional having turnover less than 50 lakhs and income less than 50% of the turnover, is he liable for tax audit? Yes, he is liable for tax audit. So very interesting question by Vishal. For an SSC having taxable income above 50 lakhs, at what value should inherited jewelry whose cost is not known and bills are not available be considered? In such scenario, if these are inherited, maybe 2001 value is what you could consider, and maybe to that extent you could do a step up in your capital balances also. So maybe the value as on 2001 is what you could consider. Yeah, I think I have covered all the relevant questions, Sahil, which were available in the question answers section.
Thank you very much, sir. I think the session was really wonderful and knowledgeable. All the audience will be greatly benefited. And just to aware all of you, today we have 1900 people joining this session on this topic. So thank you very much, sir. On behalf of Institute of Chartered Accountants of India, we always look forward to your support. For your contribution, we are very grateful. Thank you very much, sir. Once again.
Thank you. Thank you, entire team, for giving this opportunity. Thank you once again.
Yeah.
So should I discontinue now?
Yes, sir.
Yeah. Okay. Thank you. Bye.
Thank you, sir. Thank you. Yeah. Look forward to meet you also.